Can AI actually help you make money in the markets? It's a question nearly every investor has asked, especially as AI becomes more embedded in markets, business, and everyday life. But the answer isn't a simple yes or no. AI can be a powerful tool, but only when used correctly. Use the wrong way and you can lose money fast. So today, we're showing you how AI can be a game changer for investing. We'll show you how to use it, how not to use it, and how to really get the most out of AI to maximize your gains. So if that sounds good, then fire up those like and subscribe buttons and let's get into it. My name is Lewis and you're watching the AI Bureau. Before we start though, let's make one thing clear right off the bat. AI is great for many things, but predicting the future isn't one of them. It won't tell you which asset will double overnight or which nasty surprise is around the corner. It doesn't replace fundamental analysis, and it certainly won't replace your judgment. Put simply, AI is no Warren Buffett. And really, if making money were as easy as asking AI what to buy, everyone would be doing it. But does this mean that you should just ignore AI altogether? Well, definitely not. Instead of treating it like a stock picker, you could use AI as your own personal research assistant to supercharge your investment journey. Here's an example. Say you're looking at a company or a protocol that you've never heard of before. AI can quickly explain what it does, how it makes money, and who its competitors are, plus any risks involved. Best of all, it does this in seconds in plain language that anyone can understand. And if something still isn't clear, you could just ask AI to simplify it even further. This is why AI is great at summarizing documents. We all know that this is the most boring part of investment research. Think earnings reports, annual filings, white papers, regulatory disclosures, all of it. These are often long, dry documents that can take hours to get through. So why not let AI pull out the key numbers, guidance, and management flagged risks? That way, hours of reading can be done in mere minutes. Throughout those documents, you'll probably run into all kinds of technical or business jargon. Companies often use language that feels almost deliberately confusing. If you're seeing things like price to earnings ratio, yield curves, liquidity ratios, token velocity, token value locked, and so on and so forth, it can get overwhelming and vast. But AI could break all of that down clearly and level the playing field, even for newer investors. AI can also help you identify risks that you might otherwise miss. You can describe an investment, why you're interested in buying, and then ask it to challenge your thesis. From there, AI will often present risks that you hadn't considered, like regulatory exposure, debt levels, competitive threats, macro sensitivity, and more. It's not totally foolproof, but it can definitely be a solid second option. So you get the idea. AI doesn't generate instant alpha, but it does help you get to it faster by supplementing the work that you'd already be doing yourself. Think of it like a research co-pilot. It makes information more accessible, and it compresses research from hours into minutes. By using AI sensibly, you can make more informed decisions and research far more efficiently. With so many AI models out there, though, you're probably wondering which one you should be using. Well, there's no right or wrong answer here, but different AI models are better at different tasks. So let's break down 4 of the biggest names, what they're good at, where they fall short, and what you need to watch out for. Let's start with the one that you're probably most familiar with, ChatGPT, made by OpenAI. ChatGPT is free to use, but there's also a paid plan with higher usage limits and more powerful tools. Ultimately, though, you'll have more than enough tools at your disposal with the free model, and the same applies with pretty much all of the AI models that we'll be covering. ChatGPT is where most people start, and for good reason. It's a strong all-rounder for building investment frameworks. Think portfolio construction, macro analysis, or breaking down a company's business model in plain English. It can summarize long articles, list key risks, and help you slow down before acting. And with a paid plan, it can also pull the most recent market data. The catch is that ChatGPT isn't always reliable. A 2025 study found that its responses to finance and investing questions were only right about 65% of the time. Roughly 29% of responses were incomplete or misleading, while 6% were outright wrong. In other words, more than a third of its answers were unreliable. Remember this for later. Another AI model that you're probably familiar with is Claude by Anthropic. Claude is often considered better at deep, structured analysis of long documents. It's also better at writing, which is why some investors use it to turn filings, articles, and reports into quick summaries. What's particularly useful, though, is that Claude often asks follow-up questions to help refine its answers. The biggest issue with Claude is that it can be a bit slow, and unless you're using a paid membership, there's a good chance that you'll quickly burn through your free usage limits. The next AI model that you could use is Perplexity, which behaves more like a conversational search engine rather than a standard chatbot. Perplexity gives responses that summarize the findings of multiple sources and provides links to those sources so that you could verify the information yourself. But for investors, Perplexity's biggest flex is Perplexity Finance, which you'll find on the Finance tab at the top of the page. This is where Perplexity provides real-time stock data, earnings calendars, SEC filings, and the market heat map that highlights sector performance across the market. Like the rest of Perplexity, all outputs are supported with cited sources so users can verify the underlying information. That said, Perplexity has a habit of misinterpreting information, even when it links to that information itself. And while Perplexity Finance is useful for high-level research, it isn't a complete investing toolkit. It lacks robust charting features, doesn't function as a full stock screener, and isn't designed for deep financial analysis. Some options are also locked behind a pro subscription. And then, of course, there's Grok, built by Elon Musk's xAI. Grok has a unique edge, which is that it has direct access to real-time data from X, formerly Twitter. It could track what other traders and analysts are actually saying, and that real-time pulse can be a game changer. But Grok sometimes has a nasty habit of ignoring certain instructions or repeating mistakes over and over. You also have a very limited number of free prompts before you're told to pay for a membership. But I mean, hey, Elon's got to make his money somehow, right? If you're just starting out with AI, ChatGPT or Claude will cover mostly all of what you need. Just remember though, it's a research assistant, not a gospel of truth. By default, neither has real-time access to prices or breaking news, so treat their output like a well-read analyst who last updated their views maybe a month ago. Useful insights, but always worth double-checking. And by the way, once you're set up with your AI model of choice, then the easiest way to make sure that you're getting the most out of it is to sign up for the AI Bureau newsletter. It's completely free and will show you exactly how to use this once-in-a-generation tech to its full potential. All you have to do is click the link in the description or just scan the QR code that's on the screen. Now, most people who try AI for help with investing make the same mistake. They ask vague questions and they get vague answers. They forget that the quality of what AI gives you is determined by the quality of what you ask it. To avoid this, let's have a look at something called prompt engineering. It sounds technical, but it's actually pretty simple. Basically, weak prompts produce generic responses, while strong prompts give you more useful information. So, for example, let's use ChatGPT and give it a weak prompt. Something like, quote, "Tell me about Nvidia." We're given a couple of images, one of a map and some presentation slides with zero context. Pretty useless information, really. We also get a broad overview of what Nvidia does and the names of a few competitors. That's fine as an introduction, but does it give you anything that you couldn't find yourself in 2 minutes on Wikipedia? Probably not. The trick to solving this is simple. The more detail you include, the more you'll get in return. So let's replace this with a much stronger prompt. Here, we've typed the following. I'm new to investing in individual stocks. Give me a structured breakdown of Nvidia as a potential investment. Include what the company actually does, the bull case for investing, the bear case against it, 3 or 4 of the biggest risks that I should be aware of, and what specific data I should check before making a decision. Notice what changed. We told the AI our experience level. We named the specific asset. We explained our goal, evaluating it as an investment, not just learning about it. And we asked for a structured output with defined sections. Each of those inputs raises the quality of the response considerably. Here, ChatGPT's response follows the structure of our prompt. We could see Nvidia is more than just a chip company. We have info about its strong yearly revenue growth. We have concerns about high expectations, competition, and manufacturing constraints. We see the 4 big risks to be aware of and which metrics to pay close attention to. Pretty sweet, right? Of course, this is just one example, and you're welcome to play around to get the results tailored to you. But broadly speaking, your prompts should always include a few things. The first is context, like who you are, what you're doing, and your experience level. This changes the level of explanation the AI provides. You also want to be specific about the asset that you're talking about. For example, instead of referring to, quote, crypto, you might point directly to Bitcoin. Ticker symbols help too. There's no ambiguity when you say BTC or NVDA, JPM, or whatever else. Also, outline your goal. Are you trying to understand an asset from scratch? Are you comparing it to a competitor? Do you need AI to evaluate an earnings report? Or do you need to find reasons not to invest? Be explicit. This logic applies no matter what asset you're investing in. The more context you give, the more targeted the response. Think of it like briefing an analyst. The clearer your brief, the more useful the output. Okay, so now we have a brief understanding of how to use better prompts. The thing is, knowing how to prompt is one thing, but knowing what to ask for, that's another. And depending on how experienced you are as an investor, some outputs can be more useful than others. For instance, if you're a total beginner, then asking for a one-page summary is a great option. So ask for a concise overview of the asset, what it does, how it makes money, what drives its value, and what the key variables are. This gives you a foundation before you dig deeper. Then you could ask AI to present a bull case and a bear case, similar to what we just touched on. Regardless of your experience level, this is one of the most useful outputs you could get. Ask it to build the strongest possible argument for owning the asset and the strongest argument against it. The goal is to see both sides clearly before forming your own opinion. Another great thing to ask for is a risk checklist. For example, what are the main risks an investor in the asset should be aware of? Good answers should cover things like regulatory exposure, competition, balance sheet health, liquidity, macro sensitivity, and any company or sector-specific risks. Notably, though, this isn't the same as building a bear case. Risks are specific, factual vulnerabilities, while a bear case usually leans a lot on narrative. Also, ask for key numbers to verify. Ask the AI to list the financial metrics that matter most, things like revenue growth, profit margins, debt to equity, price to earnings, free cash flow yield, or whatever is relevant. Then verify these figures yourself using primary sources like SEC filings, earning reports, or reputable data providers. And as a pro tip, ask AI where it got its data from, assuming it hasn't already provided sources. You could also ask it how it would value an asset. For equities, for example, you might ask, what valuation method would analysts typically use for a company like this? And what does current consensus suggest? For crypto assets, you could ask, what on-chain or fundamental metrics are commonly used to value this protocol? Now, this won't give you a price target, but it will give you a solid framework to use. We also recommend asking the AI to compare the asset against competitors on various metrics, like margins, growth rate, market position, and valuation. Understanding how something stacks up can provide essential context for your investment decisions. For a more structured output, why not request a decision matrix? This is one of the more useful outputs that you could request. Just ask the AI, give me a table showing what factors would support buying this, waiting on it, or avoiding it. This can give you a clear overview rather than a binary yes or no. But perhaps the most powerful question you could ask is, what would make this investment thesis wrong? If the answer makes you uncomfortable, that's exactly the point. Identifying the conditions where your thesis breaks down is how you build proper risk management strategies. The idea behind all of these outputs is the same. You're looking for reasons to invest and reasons not to invest. Most investors only look for confirmation, but if you want to improve your investing, you need to actively seek out counter-arguments. As you could see, AI can give you a genuine edge in investment research, when used correctly. Use it poorly, and AI can actually be a total nightmare for investors. That's why there are a few golden rules that you need to follow, no matter what. First and foremost, never assume that any answer you get is 100% factually correct. AI models can, and often do, hallucinate. This is the technical term for when an AI produces an output that sounds plausible but is factually incorrect. And make no mistake, this isn't a rare occurrence. Hallucinations happen all the time. This is why golden rule number 2 is to always verify information using primary sources, such as company filings, official exchange data, or reputable financial data providers. Even if your AI provides a source, check that it actually exists. You'll be surprised at how often AI spits out links that take you to an error 404 screen. And this relates to golden rule number 3, which is to check the dates. AI can present data that was maybe true once, but is now outdated. That's because AI models have a training cutoff, and that cutoff could be a few months ago. So make sure that you cross-reference with current information, especially if you're using AI to research a fast-moving sector like crypto or a recent macro development. Golden rule number 4 is to always remember that AI is strangely sycophantic. It loves to tell you that you're right. But of course, this can be dangerous. A 2024 study found that simply suggesting an incorrect answer to an AI reduced its accuracy by around 27%. The model altered its response just to keep the user satisfied. OpenAI acknowledged this issue directly in May 2025 when it rolled back a ChatGPT update that users said was overly agreeable and validating. For investing, that's a real problem. If you tell an AI that you're convinced about buying something, it'll often build a compelling case for it instead of challenging you. So, whatever you do, don't use AI to validate your investment decisions. This is why golden rule number 5 is to use AI to pressure test your ideas, rather than to confirm them. Run your investment thesis through AI with the explicit goal of finding weaknesses. Ask it to play devil's advocate. Ask what the consensus view is getting wrong. Ask what the most common mistake is when investing in that particular asset. This is how to get a properly balanced view on things so that you can actually make better investment decisions. And that brings us to golden rule number 6, the most important rule of all. You should only ever use AI to build knowledge, not replace it. It shouldn't be used to skip doing the work, but to do more work faster. It should never be your only source of research. But used properly, with the right prompts and a healthy dose of skepticism, it can be one of the most powerful research tools that you have. And with that, that is going to be all for today. So if you enjoyed the video, but you haven't liked it yet, there is no time like the present. And if you know someone who might be interested in using AI in their investment journey, well, please feel free to share this video with them. Thank you all so much for watching, and I'll see you again very soon. It's Lewis, signing off.